HMRC has apologized. It overcharged around 1.7 million UK pensioners. The total overcharge was approximately £43.5 million, an average of about £25 per affected pensioner. It happened because of how HMRC calculated taxable state pension income after the annual April uprating. The correct method should use 51 weeks at the current year's rate and 1 week at the previous year's lower rate. HMRC's automated system used the wrong calculation, overstated the taxable income, and quietly deducted too much tax from around 1.7 million pensions. Most of the pensioners affected didn't know, because nobody told them. And this is not the only way pensioners are overpaying tax. It is just the latest and the most widely reported. Underneath it, there is a quieter, more structural problem that has been running for years, a problem built into the very way the UK tax system handles state pensions, private pensions, and multiple income sources in retirement. By the end of this video, you'll know exactly what to check and exactly how to get back any money HMRC has taken that it shouldn't have. Stay with me, because two things decide whether this video makes you a few pounds better off or significantly better off. The first is whether you've received a P800 tax calculation letter and what it actually means if you have. The second is a 4-year backdating window that most pensioners don't know exists. Money from overpaid tax can be reclaimed going back 4 complete tax years. For some people, that's a 4-figure sum in a single refund, and the window closes permanently as each year rolls off. But first, let me explain the structural problem, because it's the reason HMRC errors and tax code mistakes are so common for pensioners specifically. The state pension in the UK is taxable. That surprises many people because no tax is deducted directly from the state pension before it hits your bank account. The DWP pays it to you gross, the full amount, with nothing taken off. So how does HMRC collect the tax? Through your other income. If you have a private pension, a workplace pension, or any other PAYE income, HMRC adjusts the tax code on that income source to collect the tax due on your state pension as well. It essentially squeezes all the tax into one place. If your only income is the state pension, and it's below the personal allowance of £12,570, you owe no tax and there's nothing to collect. Fine. But for anyone with even a modest private pension on top, and that's most retired people, the tax code on that pension is doing double duty. It's collecting tax on the private pension income and also collecting tax on the state pension income simultaneously. That calculation needs to be exactly right, and often it isn't. There are 5 specific ways it goes wrong for pensioners. Let me take them one at a time, because one of these is almost certainly relevant to you. The first is the state pension calculation error I mentioned at the top. HMRC's automated system should calculate your taxable state pension as 51 weeks at the current rate, plus 1 week at the previous year's slightly lower rate. This is because the April uprating never perfectly aligns with the start of the tax year. If HMRC uses the new weekly rate for a full 52 weeks, it overstates your taxable income. The result is a slightly higher tax deduction from your private pension all year. It's a small amount per month, but multiplied across 1.7 million pensioners, it adds up to £43.5 million. The second is the multiple pension problem. If you have more than one pension, a state pension plus 2 workplace pensions, for example, HMRC has to split its calculations across multiple sources. The personal allowance can only be used once, but in practice, HMRC sometimes applies a standard code to each pension separately, which can result in either too much or too little tax being collected overall. A couple with 3 pensions between them receiving P800 letters demanding back taxes is not an unusual scenario. The third is the emergency tax code. This affects people who access a private pension pot for the first time. For example, a drawdown lump sum. When you take money from a pension pot for the first time, and HMRC hasn't yet issued a tax code for it, the pension provider must use an emergency code. That code applies what's called a month one approach. It assumes you will take the same amount out every single month for the rest of the year. So if you take out £10,000 in June, HMRC calculates your annual income as £120,000 and taxes you accordingly. You get a refund later, but the money is out of your account in the meantime, sometimes for months. If you've taken a pension lump sum for the first time in the last year or two and haven't checked your tax position, check. The fourth is stale tax codes. Your tax code can be based on information that's no longer accurate. If you stopped working but HMRC's record still shows employment income. If your private pension changed but your code didn't update. If your attendance allowance award changed your personal situation in ways that affect your coding. Tax codes don't always update themselves automatically, and the UHY Hacker Young accounting firm, quoted in a January 2026 briefing, warned explicitly that HMRC will not always correct overcharging mistakes automatically. If your code is wrong, it's your responsibility to spot it and correct it. The fifth is the ESC A19 concession. This one is less known but potentially the most valuable. If HMRC made a coding error, not you, not your pension provider, but HMRC themselves, and you couldn't reasonably have known that your tax was wrong, HMRC can write off the underpayment entirely under a rule called Extra Statutory Concession A19. You don't have to pay it back. This applies specifically to situations where HMRC had all the information it needed to calculate your tax correctly, delayed in doing so, and the delay lasted more than a year. If you've received an underpayment demand that stretches back more than 12 months, and you did nothing to cause it, ask HMRC explicitly about ESC A19 before agreeing to pay anything, right? So what actually comes in the post and what do you do with it? The key document is the P800. It's a tax calculation letter issued by HMRC, usually arriving between June and November after the end of the tax year. It summarizes your income for the year, the tax HMRC thinks you should have paid, and the tax you actually paid. The difference E plus or minus D is either a refund or a demand. Here's the change that most pensioners don't know about. Since May 2024, HMRC stopped issuing refunds automatically. If your P800 shows an overpayment, the letter tells you to claim it. HMRC will no longer simply send a check. You have to take action. If you can claim online, the P800 letter will say so, and you can do it through your government gateway account at gov.uk or through the HMRC app. Claims made online are typically processed within 5 working days, with the refund paid directly to your bank account. If you can't claim online, or the letter doesn't give you an online option, HMRC may post a check, but it won't happen unless you respond to the letter. What if you haven't received a P800, but you suspect you've overpaid? Don't wait for the letter. Log into your HMRC personal tax account at gov.uk and check your income tax summary. If it shows an overpayment, you can claim from there. And here's the 4-year window I promised. You can reclaim overpaid tax going back 4 complete tax years. As of the 2026/27 tax year, that means you can reclaim back to the 2022/23 tax year. Each of those years has its own deadline. The 2022/23 claim window closed on the 5th of April 2026. The 2023/24 window closes on the 5th of April 2027. The 2024/25 window closes on the 5th of April 2028. Don't miss those dates. What if the P800 shows you've underpaid? Don't panic and don't ignore it. An underpayment shown on a P800 is nearly always collected through a future tax code adjustment. HMRC deducts a bit extra from your pension each month over the following year, rather than demanding a lump sum. If the underpayment is above £3,000, they may ask for a separate payment. But before you accept any underpayment demand, check it against your own records. Compare the 800 pesos figures against your 60 pesos from your pension provider, your annual pension statements, and any DWP letters about your state pension amount. If the state pension figure HMRC is using looks higher than what you actually received, that's the calculation error I mentioned at the start. Challenge it. To challenge anything on a P800 or a tax code, call HMRC on 0300 200 3300. Have your national insurance number and the P800 reference number to hand. If the figures are wrong, they can be corrected. If you believe HMRC made a coding error that lasted for over a year, specifically ask about ESC A19. A few specific things to check on your tax code letter, also called a P2 or Notice of Coding, that arrives at the start of each tax year. First, check your personal allowance is right. It should be £12,570 for most people in 2026/27. If you've received marriage allowance, as we covered in video 8, the recipient's code should end in M and reflect a higher allowance of $13,830. Second, check there's only one personal allowance being applied across all your income sources. If you have two pension providers and both are applying the full personal allowance, HMRC is collecting far too little tax from you, and an underpayment will catch up with you eventually. Third, check whether any adjustments in your code reference old income you're no longer receiving. If a previous employer's benefits in kind are still listed, or income that ended years ago is still factored in, the code is wrong. Fourth, if you've recently started receiving a new pension, received a DWP benefit for the first time, or changed your income in any other way, tell HMRC. They don't always know until you tell them. Use your personal tax account online or call the helpline. One quick protection before we close, because fake P800 and tax refund messages are now one of the most common scam formats in the UK. A genuine P800 arrives by post, a physical letter to your address, or appears as a notification in your HMRC online account. HMRC does not text you to say you have a refund waiting. HMRC does not email you a link to claim your refund. If you get either of those, it's a scam. Forward suspicious texts to 7726. Forward suspicious emails to phishing@hmrc.gov.uk. Delete the original. Never click the link. And one more thing. Some companies advertise services helping you claim your P800 refund for a fee, sometimes a percentage of the refund. You do not need them. The claim is made directly through gov.uk or the HMRC app in minutes for free. If you use a claims management company, they take money from a refund that is entirely yours. So, two things to do. First, check your P800 if you received one, or log into your HMRC personal tax account and check your income tax summary for the last 4 years. If there's an overpayment showing, claim it. If the state pension figure looks wrong, challenge it. Second, check your current tax code. Your pension provider will have it on your statements. The basic code for most pensioners this year is 1257L. If yours is different, look up why. If it's wrong, correct it before the next tax year locks it in for another 12 months. Now, there is one more quiet injustice hiding inside the UK pension system. It's not a tax code error. It's a systematic underpayment of the state pension itself, specifically to married women who reach state pension age under the old system before April 2016. DWP has already admitted that tens of thousands of women were paid less than they were legally owed. Some have been underpaid for over a decade. HMRC has been gradually tracing and repaying them, but the process is slow. And some of the affected women don't even know they're in the group. That's the next video. The state pension underpayment scandal, who it affects, how much is owed, and how to find out if you or your mother is one of the tens of thousands still waiting. Subscribe so it lands in front of you, because every April these rules change, and the people who stay informed are the ones who don't get left behind. This channel is for general information only. We are not affiliated with HMRC, the DWP, or any government body, and nothing here is personal financial advice. All figures are current at the time of recording and can change, so always confirm your own situation at gov.uk or with a free advisor such as Citizens Advice or Age UK.